Welcome to the Rosenberg Roundup, a weekly podcast providing investors with key macro and market developments, insightful data analysis, and actionable ideas that are top of mind for the Rosenberg research team in the week ahead.
I'm Dylan Smith, and this is the Rosenberg Roundup. On today's show, we read the tea leaves on Q1 growth. We discuss the new and emerging U.S. exceptionalism, and we think about what all that means for markets and positioning. Co-hosting today, we've got Jacob Rosenberg back on the podcast. He joined us last week and is here again. Jacob, welcome along.
Thanks for having me, Dylan.
Well, Jacob, it feels like the week's already flown by. Anything top of mind for you before we kick off the pod?
Certainly. I've been reading the research this week. Feels like we're at a moment where it's actually pretty difficult to read the economic tea leaves. The data feels contradictory. There's divergences everywhere, really. It's got to be tough for someone in your position, I'd think.
Yeah, definitely getting difficult to read, but that's when it's the most fun for sure. Anything top of mind in terms of those contradictions that you're spotting?
Oh, definitely. I've noticed that all the different nowcasts of Q1 GDP growth for the U.S., they're all over the place. These things are supposed to use the latest up-to-date data to tell us where we think economic growth is going at this instant, but looks like they're picking up different signals. The Atlanta Fed model, probably the most closely watched. It's been over 3% for a while. New York Fed, below 3. St. Louis at 1.4. And our internal model, it's more like 1%. So I guess the question is, are people seeing different data? What's going on?
Yeah, same data, different models, and it's not encouraging when they disagree. So let's dig into that. I think that's a good place to start the week in review.
And we're back with the week in review. So, Dylan, let's kick things off with the first question that I have for you. What's going on with the U.S. growth to start the year?
Well, that's the big emerging question, I think, to set the narrative for the year, in addition to the kind of equity market bull run that we're seeing. Worth bearing in mind that GDP ran really, really hot at the second half of 2023, and much hotter than anyone expected. But we're getting much more mixed signals from the early data to start the year in 2024. It's still quite early. We only really have data covering January and the first couple of weeks in Feb for the most up-to-date data. But even with that, there's enough contradiction in this data to make this a bit of a choose-your-own-adventure economy at the moment. And that's what the nowcasts are telling us when you take them together. Depending on how you filter this data and what approach you take to analyzing it, you can really come up with vastly different conclusions about where we're headed in the next 12 months.
Well, let's get specific. Can you give us a few examples?
Sure. There are a lot of them, but I'll run through a couple. Take the labor markets. You've got total aggregate hours worked. So that's everyone who's in a job multiplied by all the hours they're working. And that's down, right, compared to last year. But at the same time, the headline employment number, which people look at for correlation with growth, is actually up. Wages are up, but decelerating. In fact, wages almost never fall on aggregate. So labor market seems to be signaling, depending on how you read it, higher or lower growth. Industrial construction, to take another example, is booming thanks to Biden's policy, but actual industrial production, what happens in the factories, is completely flat. And the 3-month average, so looking at it through the volatility month to month, is below the level we saw before the mid-2022 downturn, right? What about consumers? There's this big narrative of consumer resilience out there. People are able to buy now, pay later. They can borrow. They can keep spending. And yet Walmart and Home Depot are seeing expenditure per trip falling. And we saw January retail sales down, and we saw softness in the PCE number yesterday as well. And at the same time, there's a whole raft of surveys and real-time estimates that are kind of showing a slowdown underway. That's from everything from regional Fed surveys to the Chicago National Activity Indicator, which synthesizes 85 economic indicators into a kind of signal on what activity growth is doing. And even the PMI, which people got excited about picking up in the last little while, it's still sub 50, so it's still technically signaling deceleration. But those indicators were a little bit wrong towards the end of last year, and so people seem to have lost a bit of faith in them. So again, choose your own adventure.
Okay, well, I would say that it sounds like a pretty tough read right now. But maybe you can tell us what this means for investors.
Sure. Well, obviously, we're getting a lot of attention for holding on to our recession call for the next 12 months, but I don't think that's really the point at the moment, right? The point is that we're getting a series of indicators where, if you look at it right, there's a sequential slowdown underway. and lots of contradictory data around, right? So if you take that as a starting point without the context of the previous couple of quarters, you'd think, maybe I shouldn't be pricing too much growth into future earnings growth, right? And yet the stock market is on a massive bull run, right? You don't have to believe there's a recession to believe that earnings are going to come down a little bit, or expectations might be running a little bit hot, right? So the overall picture is much more uncertainty than I would say the market pricing is really building in, or the predominant media narrative is building in, right? And yet at the same time, we have 10-year US Treasuries, right, the benchmark safe asset, with yields back above 4.3%, and they had tipped under 4% towards the end of last year, which is a big move in the context of bond markets. So that's a pretty tasty yield. There's very little downside to that, we think. The Fed's not going to raise rates again. But there's a whole lot of upside when the Fed does start to cut. And so patient investors who've had good equity exposure might want to look at repositioning a bit, take those profits from equity markets and take a serious look at a potential bond bull run when the narrative starts swinging back again to Fed cutting coming into view, right? And really overall, we're cautioning against complacency. All it's going to take is a few good inflation data points for the Fed to start looking really like it's going to start cutting, and for markets to rush back into pricing that trade.
Thanks for that, Dylan. I mean, look, it's a tough to read market right now, but that's some good actionable advice that I think our audience can really take advantage of. So, Dylan, we talk a lot about the U.S. economy. We just did in our week in review, and I thought we could continue that trend for the Spotlight. Let's home in a little bit on why we're paying so much special attention to the U.S., even more than usual.
Well, if you like puzzles, Jacob, this is the big one, right? The U.S. grew around 2.6% in real terms last year. There might be some revision, but it's going to be somewhere around that. But it averaged 4% growth in the second half of the year. Right? And for the G7 as a whole and really developing markets as a whole, that number was more like 1.5% on both counts, right? Even including the U.S. And the important point, not a single large developed market accelerated in the second half of the year, right? So the US was completely alone, completely exceptional in that trend. Here's a list of economies that actually shrank, right? So they had negative growth in the second half of 2023 based on the data we have so far. Germany, France, the UK, Sweden, Canada, Japan, all got smaller in Q3 and Q4 of 2023, right? Those are all large industrialized economies, and they're all in pretty deep manufacturing recessions. Now, the US economy is so large as a share of developing markets, and these markets are kind of so interlinked through trade channels and through financial channels that it's really, really odd for such a large divergence to happen. And it's something that we don't think is getting quite enough attention as it should in terms of what it means for the outlook.
No kidding. I mean, it almost sounds like we're in something like a period of new economic U.S. exceptionalism.
Yeah, you can call it that. That's what we typed one of our pieces. We've also called it Oasis USA, and there's various things that you can do and have some fun with that. But the question we've tried to pose throughout our writing this week is whether that's a real thing, whether this effect is actually genuine, or whether it's kind of statistical, and how persistent we can think it might be.
Maybe you can give our listeners your thoughts. What exactly is explaining this? What's happening here?
Well, one theory that's getting quite a lot of airtime, which I want to just dispense with up front, is that this is an AI story, right? Everyone's very excited about AI. It's kind of driving everything right now. And the thinking goes that, ChatGPT and some of these other companies are all based in the US. And so what we're seeing is the US being ahead of other economies on AI. Now, that's not impossible. There's not really much evidence for that in the macro data, but it really is hard to see how such an incredibly massive impact could happen so quickly, even though we know that applications for AI are starting to be developed everywhere. And what's also kind of hard to believe is that AI implementation is happening only in the US, right? The leading companies might be based there, but that's not to say that a company in France is not trying to automate its manufacturing just as much as a company in the UK. So we don't really buy that story just yet, although we think there's a lot of productivity gains to come from the AI story still.
I mean, I would posit that Occam's razor might offer up the idea that there's a simpler explanation out there.
Yeah, absolutely. Simple explanations are always the best. And we put together a list this week of 10 quite simple explanations that together explain why certain unique features of the US economy explain this big divergence in global growth. And a lot of things actually clicked into place for us while we were putting this list together. I think it actually, at a time when we're getting a lot of pushback on our overall view, it kind of gave us a bit more confidence just to go through that exercise. So I won't go through the whole list here, but I'm going to highlight a couple of the major takeaways, right? The first one we've talked about a bit before on the podcast is this underappreciated fact that a huge US fiscal stimulus in 2023 accounts for about 2/3 of total growth, right? And I've started calling it an anticipatory Keynesian stimulus, right? So usually the Keynesians, everyone remembers from the economics class, would recommend that when you start hitting a recession, government spending needs to go up to counterbalance the drop-off in private activity. And it's almost like the US has done that sort of by mistake in anticipation of a coming recession. Remember that towards the end of 22, everyone thought that was on the way, and the taps got turned on big time. So for all the talk we're seeing of pre-election juicing of the economy and people being worried about that, there's no way that another 2+ percentage points of growth contribution is coming from the US, because it's the change in spending that matters. So even if the same level of spending gets repeated again, we're not going to see another big acceleration in the same way, right? So that effect is going away. The other point that we would like to make is that US consumers are a bit different, right? In a kind of non-judgmental way. We'll just say that they're different. They spend all their pandemic era savings largely. Our estimates show that those are almost down to where they were before the pandemic. They're borrowing aggressively. They're not replenishing savings. They're buying now and paying later. And it's almost become a running joke in our own sales team that, let's just say everyone else is very thrifty compared to our US clients. So that's one thing that, might carry on for a little longer, but, the legs there clearly won't last forever. And that's what the big retailers are trying to warn us in their earnings reports. And the other point that I'll make is that, we have very tight monetary policy all over the world. The lags that it's taking for that to hit the economy are much longer in the US than they are, for instance, in Europe or the UK, for a variety of reasons that we get into the piece. But the point is that, policy really is taking a while to filter through. And that means that there is still a very powerful impact to hit the US from very high interest rates. As Chairman Powell and others have warned, the kind of weird thing is that, for all the fiscal authorities acting preemptively, the Fed seems unwilling to start easing before the rubber kind of hits the road there. And so we're worried that they'll have to go a little harder than they would have wanted to if they were easing a bit earlier.
What would I take away from that? What's the bottom line here?
Let me put it this way. In retrospect, we know why the US economy outperformed last year. We know that none of those factors are particularly structural in the sense that they'll last for a very long time. We think they're all going to fade. And so although consumers might keep leveraging up, a lot of the impulse and force that we had behind the US economy in latter half of 2023 is now fading away, right? So either something else has to come up and replace it, or growth is going to tail off. Jacob, can you smell something sweet? Kind of sugary? Kind of mapley? We must be in Canada Corner.
We're on episode 5, 6 here. We're already running out of ideas to intro the segment, it sounds like.
Listen, man, this is the favorite part of my show, and I'm just getting warmed up on this stuff. So It's going to get cornier and cornier every week. Don't try to stop me.
Listen, fair enough. Either way, I think it's a good thing we're here. Yesterday we got new GDP data. Looks like we avoided a technical recession.
Narrowly by 0.1 percentage points, if you care to measure. So that's the good news. We actually grew at a rate of, if you analyze it, we grew at a rate of about 1% in Q4. And that's a touch above what people expected and is enough to avoid the 2 sequential quarters of negative growth that people usually use to flag a technical recession. But that's kind of where the good news ends, I'm afraid, because, 1% is hardly anything to get excited about. The economy shrank overall in the second half of the year, as you mentioned earlier. And in some senses, this is a bit of a worst of all worlds number for Canadians and for markets because, the media can't go ahead and beat the drum that a recession is happening in Canada on that definition. And so they can't force the Bank of Canada to respond to that narrative and maybe look at cutting rates a bit earlier rather than later. As we've said before, the bank seems very focused on housing markets. But at the same time, with immigration running very high in Canada, basically all that growth is just coming from new people arriving, right? You need much more than 1% per year to make Canadians off better individually on a per capita income. And you can find a lot of sort of, man on the street reporting, which tells you that. So, The other thing we have is that towards the end of the quarter, we get monthly numbers, and there was a loss of momentum into December when Christmas, in the US, for instance, was kind of juicing the numbers a little bit. So growth's kind of falling off. It's barely positive. It's not enough to force the bank to ease. Real incomes are falling. Productivity is flat. Housing prices are falling, but still very high, and consumers are feeling that, and they are not particularly willing to borrow in Canada. They are not spending down their excess savings. They're worried about their mortgage payments going up when they have to renew their leases. And so there's not a lot from a cyclical perspective that tells you that there's going to be any kind of oomph coming from Canada anytime soon. And that just kind of fits into this global narrative that on the recent data, right, everything isn't quite coming up smelling like roses.
That's a great note to wrap up on, I think.
Yeah, I think that's enough from us. Thanks, Jacob. I'm Dylan Smith. Jacob Rosenberg, you are my co-host, and that was the Rosenberg Roundup.
Thank you for listening to this week's episode of Rosenberg Roundup. For more information on our work and to take advantage of a free 30-day trial of our research, please visit rosenbergresearch.com. Make sure to tune in to our next episode for more insightful analysis on the macro and market landscape. Rosenberg Roundup is provided for general information and entertainment purposes only and does not constitute legal or professional advice, nor is it an offer to sell or a solicitation of an offer to purchase any security or derivative. Any views expressed by the participants of Rosenberg Roundup are solely their own and do not necessarily reflect the views, opinions, beliefs, or policies of Rosenberg Research.